Hi, in this video, I would like to talk about the changes which were made in the budget. Rather more sneakingly, they were not very well discussed and socialized. Last Friday, 24th March, the budget introduced a sweeping change in the way we manage taxes on investment portfolios. Um, they have been for quite some time the existing taxes on investments, the non-equity portfolios. So let me first tell you what the current situation is and how things changed from 1st April. So as of now, we have broadly two tax regimes which operate in India. If you are invested in Indian equity investments, where your investments are predominantly 65% or more in equities of India, you enjoy 10% tax on long-term holdings and 15% tax if your holdings are less than long-term or a short-term. So long-term over here is signified as 1 year and short-term is less than 1 year. If you're not invested in Indian equities, for example, you are invested in debt funds, bond funds, in overseas investment funds in India, or gold holdings, real estate, or whatever, anything which is non-Indian equity holdings, the taxation is based upon a long-term period of 3 years is classified as any holding of 3 years is classified as long-term, and then it is subject to a 20% tax uh, after applying capital gain indexation. Indexation is nothing but it tries to give you a benefit of inflation. So the government says, why should we tax you on inflationary impact on your investments? So every year around, depending upon how bad the inflation is, they would inflate your cost for the purpose of capital gains by around 3 to 5%. These numbers are published annually. So effectively, the effective tax rate drops down from 20% to somewhere around 15% if we consider inflation impact which the tax laws allows. So in simple terms, equity investments in India are roughly 10% for long-term holdings. Non-equities, which is bonds, gold, overseas, they are subject to 20% with indexation. If you sell this part less than 3 years, with less than 3 years holding, it gets added to your income. So whatever tax slab then you are in, if you are in lower tax slabs, it could be as the gains could be as low as tax free. If you are in higher tax slabs, you would be like 33, 30 or close to 40% tax slabs. So that is what is as of now. So they made a minor change in the budget, and they said that if the holding of Indian equity in your investments is less than 35%, this will now no longer enjoy capital gains, long-term capital gains. While it sounds small, but see the sweeping change. Less than 35% Indian equities would encompass large majority of investments. The biggest one which will get impacted is debt funds. So because they obviously have no equity in it, so they are less than 35% Indian equities. Gold funds where they have got no equities anyways. Overseas funds where they invest in US, China, or any other kind of economies of the world. From India, the funds available in India, they all get trapped under this particular tax law, which means the tax rates on them will be your normal tax rate. So this impact requires us to revisit the efficiency of those investments for all client portfolios. To summarize, the impacted portfolios or the fund investments are not just debt funds as what the mainstream media is highlighting. Yes, they are the biggest one because people generally invest over there, but it is anything which is less than 35% Indian equity. So it involves debt funds, overseas funds, gold funds. Now, how there are a certain categories of investors like non-resident Indians, NRIs, who also get equally impacted because for them as well the tax rates are similar to a resident in India, uh, but the impact is not as prevalent as in case of a resident in India. How? Uh, First of all, they if even if are they are to be taxed at a normal tax slabs in India, their income in India is minuscule, if any. I mean, there are very few NRIs who may have ongoing incomes in India. In such a case, while originally when they sell their holdings, there will be a tax which will be deducted at source at highest tax slab, say 30%. But then you file a return and claim that tax back. But and whatever would be the tax in the respective geographies, it will be applicable anyways, irrespective of whatever India does. So whether it is today or in the new tax regime, the tax still remains the same. So let's say if you are an NRI in Middle East or in, for example, Singapore or other geographies, and your tax rates were 0 or 10%, irrespective of whatever India charges, you would be kind of subject to the tax slabs of your respective geographies. Uh, yes, the TDS would be deducted at high tax slabs, so you will file a return and claim that back. Now, action plans from our end at this point of time. A bit tricky because it's very, very early days. It's not even a week since this regime was passed. So the industry, I think, will evolve very swiftly. They would try to find out options how they could re-engineer existing products or identify new products where by tweaking the allocations of the current products, could they make the overseas or gold products more tax efficient than what they become in the newer tax regime. It may take time. It may take a month, 2 months, or a few months. But what we do not want to do is take knee-jerk reactions for any of our client portfolios. We want to evaluate for each person might be in a different scenario. By introducing tax, yes, it takes some part of the return from the portfolios which are impacted, but that may not make that specific product as, how should I put it, as bad. I mean, it has its own merits, like gold has its own merit, overseas investments have their own merits. But yes, a part of it gets shaved off if a particular investment is subject to a higher tax. And it's here where we have to see whether is the industry coming up with an alternative product which we could consider, or on a case by case basis, even in the same family, there might be different investors in different tax slabs. So why would I take the same action for a client who's at a sub 10% tax slab versus a client who would be in 30% plus tax slabs? So as of now, it's not a wait and watch. We are doing a bit of reading around and trying to connect with the industry to see what actions are being taken on the investment products. And all incremental client investments, we are conscious about this tax and maybe identifying alternative investments where the money could be diverted. We may also continue to go with the existing impacted options like bonds, golds, overseas, if we see merit. But I would request all of the investors to not to take knee-jerk actions. What would max happen? I mean, it's all about, I forgot to mention that all these tax changes are for your incremental investments, which would happen from 1st April. So if you've been an investor for quite some time, you're talking about very small amount incrementally being subject to that tax. Even if we take a couple of months and not take any action and then subsequently take any action, we're talking about a very minor part which will perhaps not even move the needle for your financials. Rather than taking a knee jerk today that we stop, we kind of move to somewhere else and then we find another alternative product which might be better. It's better to kind of take a more strategic view. So you should, I would request each one of you to have some patience here. I have received multiple calls, emails, WhatsApp messages asking any actions on the portfolios, and my message is exactly what I'm just recording here. So give us some time. We would be swiftly identifying alternative options. Till such time, I think so the journey continues. Each of the products I would repeat, they have their own merits. Yes, tax may impact some over others, but the good thing is it is all grandfathered, which means your existing investments are still continuing to stay safe. It's only about incremental investments, and I hope we can kind of wait for a few months before we take such an action. So if you have any further questions or queries, please feel free to reach out to me directly. I'll be glad to kind of answer any more over there. Thank you so much.